Thank you to Rake and the MoneyWeb. It's our first collaboration on an investment forum. And I think the outcome today is testimony to the power of MoneyWeb and, of course, the topic that we are discussing. I'd like to start by focusing on the World Economic Forum. Francis quickly referred to the World Economic Forum, and that our esteemed government, the President, flies there and spends a couple of days in Davos. But the World Economic Forum is much, much more than that. In fact, one of probably the most important and largest non-governmental organizations in the world. It does an enormous amount of work all around the world. And it also publishes the World Competitiveness Report. So I thought I'd start what we say and feel about South Africa. Let's take an objective test. What somebody else who's done a lot of work and has been doing so for the last 30 years or so, has been doing on this forum. This World Economic comes out with many reports. What is a World Competitiveness Report? And it measures, it uses 12 pillars of areas in any country, and it does it all around the world. And they measure a country's competitiveness and compares it with the rest of the world. And the 12 pillars are, I'm not going to go through all of them, but we're talking about government institutions, the tax base, institutions, health, labour, infrastructure, roads, etc., etc. And they measure objectively, it's not a subjective measurement, they measure objectively how competitive a country is relative to the rest of the world. Now, about 2 or 3 weeks ago, the latest one came out, 2015, and South Africa ranked 56 on the scale out of 144 countries. That in isolation seemed okay. The report didn't get a lot of publicity in South Africa. It was published in a couple of websites, newspapers, magazines, and life carried on as usual. I think the reference there was Mauritius had overtaken South Africa on the scale. Mauritius, by the way, in 2015 is now ranked 39 out of 144 countries in terms of the competitive scale. And they make a very clear standpoint that there's a very direct correlation between competitiveness, productivity, and future prosperity. So you've got to remember that risk. So what concerns me is that going back in time, South Africa has been dropping fairly substantially in terms of its competitiveness. You can see on the slide, 10 years ago, South Africa was 39, and out of 138 countries. Mauritius, I think, was about 58, 59. And interestingly enough, as far as South Africa is concerned, Rwanda is very, very close behind South Africa, having caught up in the last couple of years. And at the rate of our decline and their ascendancy, Rwanda could be overtaking South Africa as the most, or the second most competitive country in the world. So there's one objective criteria measuring South Africa's competitiveness on a global scale. It's a worrying trend. And if you analyze it, and we don't have enough time to go through all of the points, there are some good points. Our financial system is rated highly, our auditing system is rated highly, number 2 or 3. For a while we were number 1. Banking system is rated very highly. But our labour situation and our education system, and I think Frans referred to that, we either last or second last in all of those categories when compared to African countries and also, of course, our competitive players in the world. A second report that I found fairly worrying is the A.T. Kearney Global Foreign Domestic Investment Survey. Once again, A.T. Kearney is not a well-known name in South Africa. It's not one of the largest management consulting firms, but it is a very big player. They go out every year in the last 20 years, and they're going to measure, and they're going to ask top executives of countries all around the world, what are you going to be doing about foreign direct investment? Are you going to be committing yourselves to various countries? And they put us on a scale, 25 countries, the top 25 countries, that is expected to attract foreign domestic inflows. Now, going back in time there are one or two countries always at the top. In the United States this year, surprisingly, out of the top 10, we've got about 5 European countries that is earmarked for foreign investments, which was quite surprising considering what Europe is going through. But CEOs of large companies are putting a lot of money in America, Switzerland, Norway, Finland, surprisingly enough. And for the last 3 years, South Africa has featured very well on the scale. 2012, we were number 12 on the list. 2013, we were number 14 on the list. 2014, we were back to number 12. So for a very long time, we were very much on the horizon or on the screen of the big players. In 2015, we disappeared. We're not on the list. We've totally dropped out of the list. I tried to find out a bit more information why this is. And they simply said, because of the Eskom crisis, because of the labour situation, we have totally fallen off the list as far as the big foreign companies are concerned as to whether they could consider setting up a company, factory, mine in South Africa. So that is deeply worrying. The report makes it very clear that there's a time lag between inflows or the perception of a country as a friendly investment destination and future flows a year or two down the line. Many of these countries that appear in this list of the top 25 are already back in terms of FDI to about 70% of inflows pre the great financial crash. So really coming back to where they were in 2007, and they intend in the next 2 or 3 years to get back to pre-crisis levels as far as foreign investment is concerned. The great worry is we've fallen out of the list. I can only surmise that because of the problems in Eskom, we've been put on the back burner and we'll have to wait until that problem has been solved. The Fraser Institute is a Canadian think tank, focuses on the mining sector. Canada, one of the premier mining countries in the world, they have a Fraser Institute also for the last 20 years and doing research as to which mining countries, remember not every country has a mining sector, there's about 132. Once again, there's a disturbing trend for a variety of reasons. Labour, electricity, declining ore grades, where South Africa is slowly but surely dropping out as a player, if I can use that terminology, in the mining sector. And the trend is very worrying. As recently as 2006, we were ranked still very highly, but we just kept on dropping back. And once again, you have African countries overtaking South Africa. In this instance, I think Botswana is on par with South Africa. Congo is on the list, but we are dropping back fairly dramatically. So these are actual foreigners analysing our situation and coming up with negative conclusions. And it's against that background that we have to consider our investment decisions. What are the local players? Frans referred to business confidence. Now, there are 2 very important business confidence barometers that we follow. One is the SACI, that's the South African Chamber of Commerce and Industry. They came out, in fact, 10 days ago, that business confidence index, I beg your pardon, I just want to go back, is down to 15-year lows. Last in the recession of 1999. There are a couple of you who can still remember it after the great Asian crash. That's where business confidence levels are back to. And that's been plummeting for a very, very long time. You'll find the same in the FNB BER Business Confidence Index. They just do it differently. The SACI has a range of indicators that it uses mechanically. They look at the exchange rate, unemployment, car sales, the stock exchange, the currency, and they actually measure it differently to the one by the Bureau for Economic Research at Stellenbosch University. They again send out a lot of questionnaires to a lot of business people and say, are we going up, going down, etc. Both of them confirm that business confidence is absolutely plummeting and is, in fact, we're in a recession as far as business mood is concerned. Same with consumer confidence. You don't have to talk to many people, shop owners, car salesmen. Everybody is utterly depressed. Consumer confidence down to 12-year lows. Motor car sales, I spoke to NAMSA yesterday. In 2007, South Africa sold 750,000 motor vehicles. Sales this year is set to maybe 600,000. So we have a shrinking domestic motor pool buyers. And despite financing tricks by the banks and incentives by the manufacturers, our motor industry is shrinking on a relative basis very quickly. More worryingly is that sales of light and heavy vehicle trucks, stuff like that, down about 16% year on year. And those are the companies. Companies are the ones who buy trucks. Now that's a fairly alarming system. However, the good news is, of course, we are exporting record numbers of BMWs, Mercedes-Benzes, and Toyotas to the rest of the world. So fortunately, we still have a very vibrant motor manufacturing sector that exports a lot of motor cars and a lot of foreign exchange. So the economic mood, ladies and gentlemen, at present is very fragile, and it's understandably so. At the same time, we, and any client of Brenthurst for the last couple of years will know, we've been talking about exchange rates, dangers about, and Frank put it very aptly, we have a commodity cycle. We'll come back to the commodity cycle in a second. So let's just look at the US versus the rand versus the pound sterling and the euro. Those are the three currencies. But before we do that, let's just go back in time and look at the long-term trend of the rand versus the... That goes back to, if you can see, 1980. Now, I know it's a bit small, but we put these on our website. 1980, when I was, well, that's 33 years ago and 20 kilos ago, when I started in financial journalism, the rand was the strongest currency in the world. January 1980, first day of my job, the rand was $135 for a rand. We were the biggest travelers in the world. We were the richest travelers in the world. It was the end of the commodity cycle. We were exporting gold, copper, and since then, the rand has really been on a one-way decline for most of the time. And we know that it blew out 2002, recovered, and then we had the great financial crash there again in 2008, and we're back almost where we were. So, barring these two blowout phases, you can almost draw a line, as Franz was also referring to, is a long-term cyclical downward trend in the currency that has to be taken into consideration. And it is very much linked, and there again, there's an annual figure going back to 1971. These are the average figures per year, which is slightly different. So 1971, the average exchange rate was 0.71 rand per dollar, and it just kept on sliding. There were a couple of years that it strengthened, and that was closely linked to the commodity cycle, and the average last year was 11 rand 64. I need to stop for a second. Around about, I think it was around about 1984, 1985. Now, I know you all can't see it, but 1984, the average exchange rate was 148, and the next year it was 2.24. So there was a substantial decline of the currency. And in that time, as a financial journalist, I had to go and interview Dr. Gerard Kok, the late Dr. Gerard Kok, in his office, governor of the Reserve Bank, very jovial man, sitting there in the old building, not the new building. And I was interviewing him about world events and the currency, etc. And he had a little monitor before the days of computers, and this monitor kept on beeping. Eventually I asked him, what is that, doctor? And he said, Well, that's a monitor that warns him when the rand has just dropped through another level. But he was totally relaxed about it. I said, what's going on? What are you going to do about it? And he was, as I said, very jovial guy, big smile on his face. Smiled, he said, there's absolutely bugger all I can do about it. And he didn't use the word bugger all, he used another word beginning with an F. And then he proceeded to give me a 20-minute lecture on capital flows into and out of South Africa. And it was quite an experience. He had the governor of the Reserve Bank giving me a one-on-one lesson on the commodity cycle. He said, the commodity cycle goes up, the rand goes up. The commodity cycle goes down, we go down. That's the strongest indicator, and it's all determined by those Hochenheimers, the money men in London and Frankfurt and Zurich. And ever since then, I've always been very, very sensitive towards the commodity cycle and the impact on the local investment markets. There we have the exchange rate per pound. This is the ZAR. I checked this morning, 4 years ago today, 24th of July, you pay R10.90 for a pound. It's 19.50 today. That's a decline of 73%. You've got the euro versus ZAR. Despite all its problems in Euroland, we are down about 40% against the euro, and against the dollar, we are down an astonishing 80% in 4 years today, exactly. And why has the rand been dropping like this? Well, we're not the only ones in that boat, I might just add. The other commodity currencies are also dropping. In fact, the one thing we can brag about when we talk to the All Blacks again, we can tell them that our currency is stronger than their currency for the last 12 months. They might beat us at rugby, but our currency is a little bit stronger. In fact, the New Zealand dollar is down against the rand by 12%. Same with the Australian dollar and the Canadian dollar. So it is a commodity cycle play. And we go back where France started with the story about China. There is the Bloomberg Commodity Index. It's one of the various indices we use and look at. And this measures 22 commodities up and down. That peak, as you can see, around about June 2011, the gold price peak, the platinum price peak, copper, iron ore, metal, zinc, you name it. And for some reason, it's like something slammed on brakes. And it just kept on going down. And I think, and I agree 100% with Dr. Premier, it's all to do with China. They spent, after the great financial crash, you had this massive upturn in commodities. South Africa benefited. We actually did relatively better than many other currencies because the commodity prices were going up. China was buying our stuff, like in the rest of the world, and then something changed. And we're still seeing it on a daily basis. I mean, that's been a fairly catastrophic collapse in the commodity cycle, hence the prices of that we receive for our goods, and of course also the volumes. And being China as a large trading partner, we've been hit particularly hard on the commodity cycle. Kumba's closing, iron mine, Tabazimi's closing down, and the gold shares, I'll show you in a second. I mean, we've just been smacked. And if you have not been sensitive to the commodity cycle and invested your money in there thinking it's a short-term development, you have lost a great deal of money. There are a couple of fund managers in South Africa today which still believed in the commodity cycle, and they are down, if you look at figures today, 25% for the year. I mean, well-known brand names, the Investec Value Fund, down 25% for the year. The RECM Equity Fund, down 23% for the year. And even some of the other funds, Momentum Value, down an astonishing 32% for the year. These are the funds that have not moved out of the commodity cycle, hoping for a quick return, upturn in the commodity cycle. So at Brenthurst, we stayed clear of these funds. We didn't like the commodity cycle, and you can see what the end result was. There's the gold price. And the gold price, again, in absolute free fall. from $1,900 odd 4 years ago, it's $1,100 an ounce. So our gold mines are, as we speak, busy, shutting down, closing down. The lifespans are decreasing all the time. And 30 years ago, we had 35 gold mining companies on the JSE. Today, we have 5. So, it's just not been a place to be for any retail investor. There we go with platinum. Problems with the platinum mines, very well known. And we have in the audience ex-senior gentleman who was in the platinum industry. He's just so glad he's out of that business. I mean, those mines are all busy operating at huge losses. Oil, the same thing. Not only gold and platinum, oil also collapsing. Is it shale development? Is it Iran coming onto the market? Is it Iraq? Is it lesser demand from China? It just shows you how the commodity cycle can hit a country. It's not only South Africa. There we have iron ore. Australia is the biggest iron ore producer to China, has been heavily hit. The Australian dollar 3 years ago, 105 to the dollar. Today it's 74 cents. And I was reading on the websites, they're talking about 60 cents for the Australian dollar against the Aussie, against the American dollar. The same with the New Zealand dollar. Exports of milk and milk products to China totally collapsed. Same is happening there. So we can see in 2011, we were still just about breaking even on our current account. And since then, it's just been a one-way street. I mean, that's really just blood on the street. And it's not going to get better. It's going to get worse, ladies and gentlemen. There's the 5-year trend of the current account deficit. It's stuck in 5%, 5.5%, 6%, one of the highest in the world. 5 years ago, we went countrywide, we advertised on national radio, we said that we think it's time to go offshore with some of your money. It was a difficult time to come with that proposition because the rand was strong, the local stock market was flying, the local property market was flying. We thought it was a great time to start diversifying. Back initially to convince people to take some of their money offshore. So let's see what happened. What was the outcome of that advice 4 years, 5 years ago? I might just add that since then, the sentiment has swung 100% in the opposite direction. Unfortunately for a lot of people, perhaps a little bit too late. Let us look at the JSE versus the MSCI World Index. In other words, JSE versus a world stock market. There, your cumulative return over the last 3 years for the JSE has done very well. 121%, but if you invested the same amount of money in a world index fund, your cumulative return, 196%, substantial difference. There again, we're comparing the JSE with Europe. Europe, not so good because of the problems in Greece, but nevertheless, even Greece outperformed the JSE over this last 3 years. But that's a 5-year figure, 121 versus 154. Let's compare it, and this is a chart that surprises a lot of people. And when I tell them, had you invested your money in the American stock market 5 years ago versus the JSE, your returns would double that of the South African investment. So there we have the S&P 500 up 250% in 5 years. The JSE up 121. Just to off the cuff, talking about the S&P 500, there we've had companies like, those are the top 500 companies in the United States, companies like Facebook, Google, Amazon, Nike, Apple, you name it. We just don't have those companies in South Africa. And the astonishing thing is Mark Zuckerberg in 2004 started a little company called Facebook in his college dormitory at Harvard. Yesterday, the market cap of Facebook is in $250 billion. That is a huge amount of money, ladies and gentlemen. And that story is repeated in many other companies in the United States. Google, Apple, Nike, and a host of other countries. Now, I've just done a comparison of some of the funds that we've been using in the US, like Fidelity America, up 170%, demographics. People ask me, what is a demographic fund? And a demographic is sitting right here in front of me. The baby boomers, people getting older. You invest differently. You can invest in those kind of funds around the world. Healthcare funds have been phenomenal. And then, of course, the biotech fund, 400%. Even a fund like Japan has beaten South Africa by a long shot. This is over a 3-year period of time. I can carry on. You can even India, Asia, global property. I mean, if you had not used the opportunity the last 5 years to diversify some of your money, you actually lost out on a fantastic investment opportunity. Here's a chart. What happens when you have a commodity cycle against you and also intervention by government, regulation, nationalization of mining rights, etc. That's a chart again the JSE over 5 years against the equity resources sector. And you have not made 1 cent in 5 years by being in that sector. Again, you've more than doubled your money on the other part of the market, and you stuck to resources, you made no money. In fact, 5 years later, you had a return of 1.4%. Even worse is the gold sector, and you invested an amount of money in the gold shares 5 years ago. You are now down 33%. Not up, you're down. You put in $1 million, you've got about 670,000 left. So it just shows you being in the wrong asset class, being in the wrong category, believing the cycle will turn can devastate your investment returns. One highlight, however, was our local property market. That has done very well. It's kept pace with the rest of the world, despite the currency depreciation. So if you're comparing our local market with the global real estate market, our market up 136%, your global real estate up 159%. So that's a sector that we've done fairly well. What are the risks to conclude, ladies and gentlemen? We as investment advisors have to take in all this information we get from clever people like Franz Grenier. We have to look at the trends, global trends, and there are very big global trends that you cannot ignore. China, the East, the United States, the developments in Europe. And how do you make money? And how do you prevent losses? What are the risks as far as we are concerned as investment advisors? Well, first of all, we spoke about the commodity cycle. The commodity cycle is something that I've not seen in 30 years, and it is totally collapsing. Today, when we walked in here, we had gold shares down 10%, platinum shares plunging, resources shares 4, 5, 6%. It is an absolute freefall. Now, where's this going to end? I don't think anybody knows. Is it China? Maybe the truth will come out. China is not growing at 7%, it's growing at 5%, and that's going to have a major impact on commodities, on our exports, on our balance and payments. We are very, very vulnerable. Added at the same time, talking about the global macro events, United States interest rates are set to rise. After I think it's now 8 years or 7 years of virtually zero interest rate, the ZIP policy, they're going to start raising interest rates. Europe will follow suit. We'll have to follow suit at a very vulnerable time for our economy. We're going to start pushing up interest rates, not because of inflationary problems, but to protect our balance of payments. And of course, what happens in Europe and China is very important to us as an exporting economy. And as Francis pointed out, despite this drop in the exchange rate, our exports have not picked up. And I think the key partially is manufacturing has been decimated and it is shrinking as we speak. And of course, we've got the local risks, we've got the credit ratings that are still, the credit rating agencies that are still watching us very carefully. The worst outcome is that we are downgraded once again. and that would be fairly disastrous if foreign fund managers will be forced to move some of their money out of South Africa by virtue of we being downgraded to junk status. So what are the threats to your wealth, very briefly, to end up before we take some questions? France has alluded, and as I said, we haven't coordinated our talks. I think it's quite well known that the shrinking tax base must be a major concern. I mean, the tax base is shrinking. I've done some numbers, I've written some articles on MoneyWeb about you can fit into one afternoon at the FNB Stadium, the 100,000 people, taxpayers, pay, I think, 12% of all personal income tax in the country. 100,000 people. It's a very, very small tax base. Our rising debt levels, government's debt is rising all the time. We're back to 1994. Bloomberg Misery Index, for those of you who don't know, we are the number one on the misery index. It's a combination of unemployment and inflation. I've referred to the 80 Kearney Index. We've got the issues of land reform, which is creating huge uncertainty in our farming community. We could be having water shedding soon, and possibly even food shortages. A report by Deloitte recently pointed out if these trends happen and continue in the farming community, we could be ending up with food shortages. Eskom load shedding, I don't have to tell you too much about that. I think it is the greatest economic and financial calamity that has hit this country. I don't believe it's going to be over in 2 years. I think it's semi-permanently. I just don't see them fixing their problems. We've got the mining strikes. We've got the socialistic policies of the ANC, land reforms, etc., 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 as I referred to. So, ladies and gentlemen, just to end up, it makes life very difficult for us as investment advisors. There are so many variables in the air, there are so many uncertainties, but we end up by still advocating a further diversification, and I stress the word diversification of your personal portfolio, not because we think the rand will continue collapsing at the rate that it has for the last 4 years. That would be a very dangerous projection to make. However, we feel diversification at this point in time as to your personal investments far outweighs rand weakness, rand strength. We are only 0.69% of world GDP. We are suggesting a portion of your portfolio should be in the United States, should be in the technology sector, the healthcare sector, the biotechnology sector, or global property, purely for diversification purposes. You cannot simply safely assume that you'll be all right with all your money in one investment pot. There are simply too many variables, too many uncertainties, and there are a lot of things that we do not control. Government can decide tomorrow there's too much money flowing out of the country, we will stop this foreign investment allowance. I'm quite surprised they've been so liberal in this regard, allowing people to effectively move all their money. That'll put a stop to that. So, a lot of uncertainties, ladies and gentlemen. Thank you very much for coming. I'd like to thank Ray van Niekerk and the MoneyWeb team. I'd like to thank Dr. Frans Cronje for speaking here this afternoon, and the Brenthurst team. But lastly, I'd like to thank you all for coming here. Give up 2 hours of your time. The good news is there is load shedding out there. What was that, the bad news? And I'd like to thank you very much for coming here. Thank you very much, ladies and gentlemen.